Hello, investors and traders, and welcome to the Midweek Report. I'm AJ Monte, and this is a daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. Now, I've said this many times before, but I'll say it again. I recommend that people go back and listen to the last report to get a review as I go and move forward into my price targets for the rest of this week. And what that does, it usually helps you get an idea of what we're looking at as far as the signals are concerned. So I thought I'd do a little bit of a favor for everyone. I took a snippet of what I talked about last Friday for DIA. So let me show that to you now, and then we'll come back to the charts. But I do believe next week, Monday and Tuesday especially, I think we could rally up towards that moving average. And it's going to form what I believe is a new ABCD pattern, which will eventually get us down to this low here at 425.51. We take this 1 week at a time. If you're a regular follower, you'll know that I use a 7-point trading checklist to pick my target numbers. And I follow the candles, I follow the volume, I look at the wide divergences from the moving average, I look at the oscillators down below, the stochastic and the CCI, and I also pay very close attention to gaps. So I do believe that this gap is going to fill right there at 439.97, and then I think we could go a little bit higher than that, which will bring us to that moving average because the moving average is still moving lower. So my upside target for DIA for next week is not a big move, but it's 440.82. Okay, so as you can see, I did say that we would go up to fill that gap right there, which we did, and then follow up with a test of that 20-period moving average, which we did. Now, did we hit that upside target exactly to the penny? No, we missed that by pennies. But of course, there's always going to be the folks that have that technical analysis chip on their shoulder pointing out, oh, you missed by a couple of pennies. Well, that's going to happen from time to time. But I assure you, especially for the folks that are listening to this for the first time, there's no one in the world that has a better hit rate at 82.2%, which is what we're currently holding right now. Now, moving on to what I said in that video again, I said that we'll most likely pull back from that C, which would then create the ABCD and then move us to a lower D to hit this target down here. And that is exactly what we have. And so now, if you look at this candle right here, you could see that we are forming a bullish engulfing candle. So I do think we're going to move right back up to that moving average. On the midweek report, I do not put my target lines. I only do that on Friday to keep things clean. But I would expect a continued rally up towards that moving average. You can see down below, we have almost a buy signal on the CCI. Once it crosses over that green line, that would be the buy signal. So stay tuned for anyone that's looking to trade short-term positions. Again, on the option side, I would say maybe consider looking at out-of-the-money weekly short-term credit put spreads, maybe going in with some diagonal calendar call spreads just to give those option traders some ideas there. And we must be doing something right because we had a record number of new subscribers come in just from Friday. So thank you so much, all of you brand new folks. I will continue to deliver the content and add value whenever possible. All right, so let's go to IWM. IWM did not move up at all, and that's to be expected, especially when you see that bearish engulfing candle right there from Monday. Let me zoom in there for you. But I am keeping that upside target of 219.08 for IWM. Again, look down below. I use a trading checklist, so let me just show you what I'm talking about here. I look at the chart, I look at the buy signals versus the sell signals. What do we have? Well, we have a half signal there. We have a higher low on lower volume, so that candle right there is bullish. The lower volume on the way down is bullish. We have a wide divergence from that moving average. That too is bullish because we call that the rubber band effect. We have the oscillators down below crossing with a buy signal here. We're oversold and just about to cross above that buy signal down there for the oscillators. So those both are buy signals. So now looking at the sell signal category here, what do we have? 0. And that's how we do it. We use the trading checklist, and we give this out to everyone in the public. All you have to do is email us, and we'll give you a hard copy of that in PDF format. And when you have all of the signals going one way or the other, you could be sure that the buyers are coming in like we're seeing here, or if the sell signals are stacked up, we're looking at more selling pressure coming into the market. So I do think that we could go up to that moving average again, at which time we could see a new formation of a brand new ABCD pattern. Remember what that ABCD pattern looks like when you have an A going to a lower B. A lot of times we get that jump or bounce to C, and then any pullback from C generally brings us to a lower D. So it most definitely looks like we are moving into a bear market. Looking at QQQ, which is the tech sector, it's going to be the same scenario. We have this half signal down here, bullish. We have the drop in volume on the way down, bullish, wide divergence from the moving average, bullish. Look at the oscillators. Bullish, bullish. Look at, we did get the buy signal. Look at that little bubble off to the right. You see that minus 95.365? Well, when it crosses above the minus 100 mark, that is when the buy signal is generated. So I'm still keeping that upside target on QQQ at 514.81. Looking at SPY, very interesting combination of candles right here. We have a bullish engulfing candle, folks. Now, I'm not quite sure we're going to get all the way up to that moving average, and here's why. See this horizontal dotted line? That is a support level that was broken right here. I do think we'll move up to that line. That's right around the 590 level, but there could be some resistance in that roll reversal, so keep an eye on that. That's another pattern that I talk about quite often. Again, it's a stick figure pattern that you could memorize pretty much. Finding it on the chart is a little bit more difficult, but it's not rocket science. Remember, once support is broken, it generally turns to resistance. So SPY a little bit higher. Now, let's talk about the VIX. Here's where I got the most backlash from the social media crowd. Remember, these are the folks that have that chip on their shoulder. I have to, when I get comments, I just have to chuckle because these are the folks that really don't know how to read the charts. But that's what I'm doing, is I'm teaching the public how to read the charts. Remember, weeks ago, I had that extreme target of $27, and I even identified it as an extreme target of 27. Well, yesterday, look what happened. It went up to 26.35. Missed that by 65 cents, folks. Well, that's pretty close. We go to the penny, and I hold myself accountable to the penny. But in the meantime, after coming that close to hitting that target of 27, I do believe the VIX is going to pull back towards that moving average. I still have a downside target of 1851. Look down below. You read the oscillators the same way with the VIX as you would any stock. We still have the stochastic moving lower. We have a very close sell signal forming right here. Once it drops below the plus 100, which is that red line, then we could expect a continued drop. Now, the difference here on the VIX is that we have a pivot. See, a lower high followed by a lower low. So that would tell me that we're going to continue a little bit lower towards the end of the week. Now, another thing I want to point out to you, if you go to our YouTube page, we have a brand new member, that's Andrew Faldi, and he is showing people how to trade low risk, high probability spreads using very, very simple concepts to understand. Now, this most likely will not be something for the brand new option trader who's a novice and barely knows the difference between a put and a call. However, you can grow into that to get to the more intermediate levels. Andrew is our newest member. He's a contributor. He is a registered investment advisor. He's got all the credentials, and we're very happy to have Andrew joining us. So make sure you go to that page, click on that very short video, learn a little bit each time. And that's our promise to you. We're hoping that each time you watch a video, you're going to learn something, whether it be the ABCD pattern, a roll reversal, engulfing candles, whatever it may be, shooting stars like we saw here. Yesterday, it's a shooting star, long shadow on top with a small body candle. That's bearish 80% of the time. And then every now and then I'm going to talk about the precious metals, which this week I have to talk about SLV. Our members got into a long SLV position last week, and it's rallying quite nicely. You can see today we crossed over that momentum line. Now what that means, again, here's another lesson for the newbies. When that zero line, which is the black line down here, when you get across above that, you generally get 2 to 4 days of upside momentum, again, in the direction of the cross. If it crosses below that momentum line, like we see what happened back here, you then would expect 2 to 4 days of movement to the downside, again, in the direction of the cross. And what do we have? 4 days before the bounce. See how that works? Don't take my word on that. Here's a cross to the upside. What do we have? 4 days to the upside. Here's another one to the downside. What happened? Right here, we had 1, 2, 3, 4, bottomed out at 5 and 6, and then had the little bit of a bounce. So that's what we talk about. 2 to 4 days on average, that momentum will continue, again, in the direction of the cross. Folks, thank you so much for joining us. Tonight, we have the rapid fire session from 6 to 7. If you'd like to try that out as a trial member for 15 days, we have a free membership, no obligation at all, no credit cards needed. We don't play any of those sales games where we trap you to where you have to cancel. We don't do that. You don't have to even renew if you don't want to. You could sign up for 15 days. It drops off after 15 days. Of course, if you do want to come back, you can enroll. It's totally up to you. No pressure. Thanks again. Have a great rest of the week. So long.